and welcome back to the Private Practice Growth Club YouTube channel. If you're new here, I'm Tasneem Abrams. I'm the founder of the Private Practice Growth Club, and on this channel, we share tips, tools, and tutorials for health professionals starting and growing a private practice in South Africa. Now, one of the questions that comes up a lot is around business structures and tax. And so I'm really happy to welcome my guest today, Natasha, who is a tax practitioner. And I just love her Instagram because she gives tax advice in really short, easily digestible snippets, because sometimes it can just all go over your head. So
That's
welcome
true.
and thank you so much for joining me today.
Thank you for having me. It's amazing to be here. I love your work. I love the content that you're putting out. So I think we are the same, kind of educate, empower, make people a little bit less scared, demystify. So I absolutely love being here.
Thank you so much. And so maybe to start off with, you can first tell everybody a little bit more about you and what services you provide.
So I have a company. I have a few accounting firms, but the one that is most known is called Lorde Business Solutions. And essentially what we do is we come in and we help people with tax. We help them plan their tax. We help them not be afraid of their tax, take away a bit of the anxiety by, empowering them with information. And then on a more kind of recurring basis, we then have our bookkeeping or retainer kind of clients that we take on, and we make sure they're compliant, as well as business advisory and business development as well, because tax is so after the fact. So we like to get in and kind of figure out what are the decisions that led to this process and how can we make things a bit better for the business and the business owner.
I love that you mentioned, that tax tends to be a very after the fact kind of thing, which I think is whether in your personal capacity as an employee or as a business owner, I would say that really is the truth for most people.
Yeah.
It's like only when tax time comes around, then you're like, oh my word, I have to submit my tax returns. But so just before we get into like the questions that I had, can you maybe talk to the importance of being more proactive and why it's important to consider tax implications even in your business decisions? Because most people will just like, okay, this is the next step, I need to do this now, but they don't actually think, well, what are the tax implications and is that actually wise to do?
No, that's a good one. I'm very pro being proactive versus reactive, because a lot of the anxiety that people feel stems from that reactivity. So they never feel like they're participating. They kind of just feel like they're always being tugged in the direction of the most urgency. And that's usually in the form of a tax deadline. The other thing is that a lot of the tax incentives take a year to play out. So it's very important to know that if I am tax planning, and I always say, don't get to the end of your tax season and not have an estimated Rand value that you're either going to be refunded or you're going to pay. So you are able to do that. And I think a lot of people don't know that. And so that's the first step, is getting people comfortable with the fact that you are able to plan it down to an estimated Rand figure. And then you can look at your specific implication, your specific circumstance, and see kind of which sort of incentives, which sort of, things are available for that, your specific context. So when people come to me, that's the first thing. We establish a baseline of the different events that they have going in their life. Are they married? Are they taking care of family? How are they paying themselves? All of these different variables. How much are they paying themselves? Are they planning to have property, investment property, rental property, all of these variables? And then we say, all right, given that, these are the tax events that are created and that arise. And then these are the tax incentives that we can apply, or tax strategies that we can apply to reduce the tax. And that just opens up options for people. So especially if people find that they struggle with kind of anxiety or fear around the whole topic, it's best to then plan and then to figure out exactly, oh yeah, I've got, when they come and we do a game plan, it's a PDF, it's like a roadmap. You can always refer to it. You can always take it somewhere else for a second, third opinion, but it's important to have something down on paper.
So one of the decisions that private practice owners have to make, which relates very closely to tax, is what type of business structure they decide to operate as. And most private practice owners start off as a sole prop because, of course, they don't have any revenue coming in. They're just starting out. So I want to just focus today's interview specifically on sole props. Can you tell me what are the pros and cons of operating as a sole prop as opposed to registering a company from a tax perspective?
Tax perspective. In this instance, because when you're just starting out, you don't have a lot of capital outlay, you don't have a lot of money to start, consulting professionals constantly. So the biggest thing is learning how to pay yourself in a tax savvy way. And when you are a sole proprietor, you are the be all end all, the alpha and omega of your business. So it's a lot easier to essentially pay yourself as opposed to if you had a business and then you had to transfer it to yourself and you don't have a good tax strategy, you're going to get double taxed in the most tremendous ways. You're going to end up paying 27% now, 27% tax here, and then another maybe 20%. Or even more, depending on how much a person decides to pay themselves. So you could be racking up a huge tax bill just because of not being able to know how to pay yourself. So with a sole prop, when you're starting out, you don't have to register to become a sole proprietor. That's the easiest thing as well, whereas you're registering a company. You are going to have the same type of thing as a company, right? So you are going to have financial statements and so forth. And for the most part, you're going to find that people's profit, which is their income less expenses, is not going to exceed the 218,000 threshold. That's important because at that point, you're only paying 18% in tax. Versus if you were a company, there's small business tax rates where you can pay absolutely nothing in tax, but then with because it's healthcare professionals, they're most times they might fall into a personal service provider definition, which excludes them from participating in that. Might, not always, but it's a possibility. So in that case, you're probably going to end up having a lower tax rate than, say, your 27, 28%, depending on the year.
So talking about profit, I think a lot of, because as health professionals, we're not taught to be business people. We are taught to do a hand splint or teach children how to write. So it's not really something that you think about when we decide, okay, we're going to start a practice, which is essentially a business. So I think I've noticed that a lot of health professionals in private practice, they almost confuse profit with salary, like especially as sole props. They think, oh, whatever money's left, that's my income. But even if you are a sole prop, it's still two separate things, right? So can you just tell me, like, how would, because if you are being taxed on profit, what can you include as tax deductible, first of all, as expenses if you are your business? But then on the other hand, then how does salary or what you pay yourself factor into that? Because you're not going to be taxed on your salary as you would if you worked for your company. But your salary is kind of part of the profit, is it not? I don't know. It's confusing.
It's confusing. Yeah. So this is actually legally a sole proprietor is the individual. So in this specific case, yes, you are your business. In a different case where you had a company, the company is something called a juristic person, and a person is someone called a natural person. So in this case, a natural person is the company and the owner. In that case, a juristic person is the company, but the person running the company would be a natural person. That's the legal kind of terminology. But when you're paying yourself, especially when you're a sole proprietor, it sits down, and this is why I always sit down and speak to the owner, right? Because that talks to a lot. Like we said, tax is very after the fact. So that gets into the business consulting of how do you want to scale, where do you want to go, and how do you want to grow? And that will determine the way that you start using your cash and your capital, and you decide what it is that you want to do. Maybe you never stop being a sole proprietor, and that's fine. That works for you. But it depends on where you want to grow. Is this something you want to build into a brand? Is this something you want to franchise? Is this something that you're aiming to have a specific amount of clients or a specific revenue model? Is this something that works? Is it challenging the market? Is it fitting into the market? Are you in dense areas and you're having a great foot traffic or great people, or you're in a very, competitive area? So it starts talking to the realistic expectations that an owner can set. And from setting that, you can then say, well, if this is my consistent profit, how am I going to participate in this? What are my personal needs, wants, goals, and dreams for the year? And when you do that, you don't get taxed separately. It's everything just becomes profit. And all of the deductions are included in something called Section 11. But some examples would be entertainment costs, the rental for the facilities that you use, consumables, so your alcohol pads, your needles, so forth. It would be if you have someone who's your admin, maybe that's a salary or just a stipend, whatever it may be, utilities, entertainment costs. Even if you're buying kind of coffees and cream for the kitchen, you can also deduct that. So there are a lot of deductibles. Then factoring into your personal side, you're also able to include a lot of things. So your insurance, whether it's personal or business, you're allowed to, it's a little bit nuanced. You'd have to speak to someone specifically about the case to see how you can do something called ring fencing, what it is that are your personal expenses. And because you are so much the business, sometimes like your petrol, your car, your tire needs to be fixed. Because you're so much your business in the sole proprietor sense, it lends itself to allowing a lot more personal expenses in because you are the one who needs to render the service. So, I mean, if you go and get your eyes checked and you need to get spectacles, if you don't have spectacles, can't do your business. So it just depends on the context. But in most cases, I would say about 60 to 70% of your personal expenses are able to be included. And then obviously your business expenses, because they're so interlinked and interchangeable. And then that reduces your profit down and you then pay tax on the difference. So in terms of paying your salary, yes, profit is technically your salary, if you want to call that. But in the eyes of the law, right now, you're kind of one and the same. So it's more of working on what's a profit or a loss, and how does that affect your growth and your dreams.
So what I'm understanding you say is that at the end of the day, as a sole prop, you get taxed on your profit. The fact that you maybe only take, say, 50% of your profit as payment to yourself and keep the rest as operating profit, that's more of an accounting thing. That's got nothing to do with tax necessarily. So but then it also sounds like I would imagine there are lots of practitioners who are not deducting as much as they potentially could, because I mean, I didn't know that there were certain things you could ring fence, but like you're saying, you need somebody who knows the tax law and things like that to be able to understand, because you don't also want to be audited for, chucking everything and your dog into
and you should know, because I think that's the biggest fear of people is being audited. But I think the best thing to preempt that is that, well, it might happen. It's a possibility, especially now. I mean, I'm going to post a video about this, but the finance minister is really moving to collect a lot more tax. And in the recent months, since September, Edward Kruiswater, he's the commissioner of SARS, he's collected so much in tax just because they're doing a lot more final demands and taking a lot closer look at audits and refunds and so forth. So there is a huge move to collect more tax. And the personal tax provision is the one that accounts for the majority of the state income. Tax itself accounts for 90% of state income. So this move to collect more tax is a move to be more transparent, and they're going to look more into things. And so the important thing is to understand, what are they looking for? Are you prepared for it? Should it happen? And, that should relax you. I've spent a lot of time dealing with people, small audits, 20,000, large audits, 75 million, dealing with what is it that SARS is actually auditing you for and what to do about it, and having the conversation with them, going to their offices, really presenting the documentation, presenting the case. Sometimes the client doesn't have certain things. My one client, his accountant passed on. He has no idea what's going on, So these are the things that happen, and you should be able to be okay with it. However, a lot of people don't do that initial kind of consultation of a professional to know. In my specific case, and it's always case specific, what happens, what is allowable, what can I actually include in my return. I just got my client like 82,000 Rand back in taxes because they had overpaid in tax because they hadn't dealt with the sole proprietor element quite correctly. They hadn't included all of the deductibles. So it wasn't wrong, but it wasn't, optimized. And so I said, this is what we're going to do. Here's the tax law. This is, the subsection. This is the paragraph. This is what we're doing. And this is why that return wasn't wrong, but this return can help you get the cash that you overpaid back. And so we did that for his business. That was like 200,000-300,000 that came back. We did that for the personal, and for each year it was 100,000, 80,000, this much, just to recover the tax that was overpaid. So you are allowed to do that as well, which I don't know if people do know. But you are allowed to get it back. You are allowed to supply the documentation. They'll ask for more documentation. They may not include everything, but at least you get a huge chunk back, because they are a bit stubborn right now. They want to retain as much money as possible. So yeah, refunds are taking long. Audits are taking forever. Some of it took a year for us to recover that. And it's just like, this is so long. It's only supposed to take 3 working days. So imagine waiting a whole year for this. And it was just crazy. But in the end, he managed to get his tax back.
So speaking about audits, this wasn't what I was going to ask, but it just made me think of that now. As a sole proprietor, how do you proactively prepare for audits in terms of what you need to keep? I know people always say you must keep receipts and things like that. But say if somebody sends you an invoice online, is that good enough? Do you always have to keep like slips? Like if you buy something at P&A, for example, for stationery, and you paid on your card and it says P&A, do you still need to have like the physical receipt? And if they do audit you and you don't have all the receipts, you've lost some of them, does that mean you just have to be like, well, unfortunately, I don't have the receipts? Can you maybe speak on that?
Yeah. To be fair, in most of my experience, they have accepted bank statements where it's clear. So if you're in a large cash business and you're withdrawing cash, it is, I did that for one of my clients, and that was a real conversation because it was contextual. It's construction. You're paying a lot of your workers cash. I had to explain to SARS, look, the best we can do is give you payroll schedules that this is what happened. So because I was the same client of mine whose accountant passed on, so he hadn't obviously kept his receipts and so forth, and he had VAT. So usually a person who's registered for VAT, they may want to look more deeply into your receipts because you're supposed to keep them anyhow. But for the most part, if the bank statements are clear and you kind of work digitally, they do accept it, but you have to kind of choose what you're going to choose. Is it going to be slips or is it going to be bank statements? You can't mix and match. I have some bank statements and some slips. So you have to choose what you want. For audits to be proactive, you need to know what your tax requirements are. So if your tax type is a sole proprietor, your tax type is an income tax return, and also your provisional tax return, which is your IRP6 and something called an ITR 12, income tax return 12. That's going to be your annual tax return. When you are submitting that return, it's important to know the documentationary requirements. So which documents do I need to submit? And then figuring out, can I put together that documentation, or do I have to get someone else to do that? Most times, especially for sole props, it's a type of business. You get amazing deductions. You're not paying pay-as-you-earn tax, so that's amazing deductions. You're not paying that much tax, but you are, as a usual person who is earning that amount, you will be paying tremendous amount less. But the issue is there's an additional compliance requirement. So pay as you earn, everything's done for you. You don't have to do anything. Great, you're paying more tax. But if you're a sole prop, you need to do things like your financial statements. And a lot of people don't know what those are. So usually when we do financial statements, we sit down, even if you just get a visual, even if I say financial statements, just to see what it is. Maybe you don't get it, but you see it. So that's the important part, is understanding the documents you need and understanding who can get that done for you and how long that takes, so that when it comes up, you're not like, what are financial statements? I've never heard about this in my life, because your accountant was just kind of doing everything for you. And it's good. They should, but you should know as well. You should really, really know, because it's your responsibility as well.
So seeing as you brought up provisional tax, can we talk about that? Like, who needs to pay? What is provisional tax, first of all, and who is supposed to pay it, and when are you supposed to pay it, and how do you pay it?
Yeah. So provisional tax is one of those things that SARS has become a lot more loud about. So SARS is doing two things. They're raising awareness on what they want so that they can be more harsh with if you don't do it. Because like 5 years ago, people weren't getting as much communication as they're getting from SARS now. We didn't even have auto assessments. We didn't have people even being reminded about provisional tax. It was such a struggle to convince people that provisional tax is a real thing. They're like, what is that? So provisional tax is essentially just an estimate. It helps people, especially if you're self-employed. It's a fluctuating amount of money. It helps you plan out your tax a year in advance. And then if you have to pay, break up those payments into 2 or 3 payments. For most people, it's going to be 2. The slim minority, it's like tiny, and you're going to have 3 payments, right? So I am providing for the next 6 months. It's always in foresight. And your annual tax is always in hindsight. So provisional tax, if I'm going to be a provisional taxpayer, it's February and August most times for most people. You're going to have February, so it's every 6 months. You're going to have 2 returns due in February, which is your hindsight return, your income tax return, and then your foresight return, your provisional tax return. That return is saying, well, in the next year, I think I'm going to pay 10,000 Rand in tax. So in the next 6 months, I think I'm going to pay 5. And then I pay 5 now. And then come the next 6 months, I'm like, in the next 6 months, I think I'm going to pay another 5, and I pay 5 now. So that when my hindsight tax return comes in, I've kind of paid tax in advance. So it's a cool tactic for SARS to kind of hang on to their money. And then, if you've overpaid, they'll just refund you. That's pretty quick. Or if you've underpaid, you'll just pay the difference. But it's not as much as maybe paying 12,000 Rand in total. You've paid 5, and now you're like, oh, there's still another 2. Let me pay the remaining. That's where you get the 3 returns, provisional returns done.
So in other words, provisional tax is almost a way of SARS helping you to be able to pay it in smaller chunks rather than paying a bulk amount at the end.
Exactly.
But now as you say, if you overestimate how much you're going to need to pay, then you will just get that money back. But you might have to pay in if you are underpaying what needs to come in. So then what is the difference between provisional tax and pay as you earn?
So pay as you earn is actually only on salaried employees. Technically, in the way that I can hear you're asking it, because sole proprietors pay as you earn tax rates, but they don't pay as you earn as a salaried employee. They would pay it on their profits, but it would be the same rate. So if you earn 200,000, you're paying the 18% on the amount versus on the difference on the profit versus someone who's a salaried employee who would pay that on the entire 200,000. So pay as you earn is simply a mechanism that is your normal personal tax. And what would happen is that if you're a salaried employee, you would get that. Now, I think also what you're trying to get to is if you are a doctor and you want to kind of pay yourself a salary, how does that look like? Do you pay as you earn? In this case, I would say sure, but it doesn't make much sense. Like you can register your sole proprietor, you can do your IRP 5s and then, kind of get double tax, but you don't have to because it's a sole proprietor. And in the eyes of the law, that's pretty much one thing. So there is no need to do that. You definitely can, but there's absolutely no need. It is a tax type you register for separately. The tax number is like 10 digits and it starts with a 7 all the time. So if you have a company, sometimes people would register their company for pay as you earn for themselves if they want to, which is not the best route personally, in my opinion, but you can also do that you have to do that for your employees, because once you do own a business, it's the company's responsibility to make sure that their employees' taxes are taken care of. And that is actually how you would generate an IRP 5.
Okay, so what I'm understanding you say is that provisional tax is almost like your pay as you earn, but it's just that you're paying it as a business.
Yes.
And it's paid twice, so it's paid every 6 months, whereas pay as you earn is what your employer pays on your behalf to SARS. Same thing, breaking up your annual tax over a period of 12 months. And pay as you earn is paid monthly as opposed to provisional tax, which is paid every 6 months.
Exactly.
So would you say then, if you are somebody who knows that you're not very disciplined with, putting your tax money aside so that you can afford your provisional tax submission like twice a year, and you would prefer to pay monthly, would you then say you can, as a sole prop, have the option to register yourself for pay as you earn so that you can put, the money's gone, so you can't spend it. And in that way, at least at the end of your tax year, you can maybe potentially get money back.
Yeah, not exactly. The reason is that the return is extremely different. So you kind of can't have your cake and eat it too. With the pay as you earn, you are strictly on employee deductions. So yeah, they're so tiny. You don't have much to work with, to be honest. So you would be paying it as like a salaried employee, which means you're paying a really high tax bill. Even if you're paying it monthly, you're paying an exorbitant tax bill, versus when you are a sole prop, you can reduce it. And this is the point of tax planning. So sometimes you don't even know what it looks like or how much you are supposed to pay in taxes. And so you kind of get slapped with a huge amount of money that you need to pay at the end of the year, because it is a personal tax rate. So it does run high. But people don't really know how to plan it or optimize it enough to know exactly what they're paying. So next thing, you're hit with like a 50,000 Rand tax bill and you're like, what is happening? So that is very jarring for people. And I understand that, but the two are not, they're kind of the same, but they're not the same. They're like cousins. Yeah.
Okay. And if you are registered for pay as you earn, do you still have to pay provisional tax, or do the two cancel each other out?
Yeah, the two do cancel each other out. Provisional taxpayers they're a different type of taxpayer versus provisional tax, even when they submit. So personal tax season closed now on the 24th of October, but provisional tax runs February and August every year. So it is different. It's two different tax types, and they're submitted and they're treated very differently, legislatively and also accounting wise as well.
So now, if a sole prop, you are your business, right? Mm-hmm. Then what happens if a lot of health practitioners, they either operate, say, from their residential property, and they maybe have a separate cottage and they have their practice there, and then maybe they will, because they maybe not there all the time, maybe they only work half day, so then they'll maybe rent out their practice rooms on a sessional basis to other practitioners, or they are renting a space in a building and they sublet to someone for the times that they're not there. But because you are your business, then I'm sure that's different to if you're a company. What is the tax implication of subletting rental income that's coming in? Is it for part of your business revenue, or is it a separate revenue now? Is it like,
It's actually, you can do that in both ways. So on your tax return, you can say, one of the questions is, have you received any income from rental activities in the past period? And if you click yes, they ask you how many separate activities. Maybe you had one, which is your subletting activity. And then that opens up a new avenue of deductions as well. You can reduce it by commission fees, utilities, all of the interest that you have on your bond, depending on how you're doing this. So you can kind of apportion those costs to the space or the place that you're letting. So that's one option. You can do that, and it adds a section that needs to be taxed, and that gets taxed in your personal tax rate. Or you could include it in your financial activities as other income. So when you do your financial statements, you have normal income and then you have other income like this. It's not directly the same, but it's not also very different. So you can include it as other income, and it is actually usually rental income. It's one of the most common other incomes. And so you include that in, and then all of those deductions, you just throw them in with the normal tax return. So if you're talking about your Wi-Fi, if you're talking about, repairs and maintenance costs for the place, you just include it in the entire thing, consolidated, and all those expenses can then reduce your profit, and then you get taxed, consolidatedly. But it would kind of equate to the same thing. I just think that when you do it on financial statements, it's just a lot easier, like administratively, versus trying to say, well, this is this floor space. I only used electricity, like my electricity bill is 2,000 Rand, but trying to apportion it enough, but I only use it for this many days, 500 rand. So it's a lot. It's much easier to just throw everything into that one basket and kind of reduce it like that.
But now, speaking of that, if you are operating from your residential property, and a lot of practitioners like myself are virtual, so I'm inside my house, right? But now, when it comes to deducting, because our bond is in both my husband and I's name, and we married in community of property, and I'm only using one room in the house. So how would I calculate if I want to take off deductions because I'm using the house's Wi-Fi, I'm using the electricity, I'm drinking tea and coffee during my work day. I'm technically at work. Like, how do I then calculate how much I can deduct, and what evidence would SARS need, or is there a calculation that they do to determine how much you can actually deduct?
There is, when you're doing it kind of with personal tax. So with personal tax, if you're trying to deduct kind of home office expenses, which would be a portion of the rent or interest, or repairs and maintenance, if you repaired the whole house, you can apportion it like that. But with sole proprietors, there's a little bit more wiggle room, because you could make the case that the whole house is your office. You could really make the case. So if you having the bond, your interest on bond, you are paying it through the company because it's you're a sole prop. So you are able to, in most cases, deduct a huge chunk of that, if not 100% of that, off of your entire thing. With personal taxes, where it becomes a lot more stringent, because you have to get a letter from your employer, you have to provide floor plans, you have to take pictures of the space. Like, there's a lot more to prove under the personal tax. But with sole proprietors, with the business, it's just a lot more fluid.
Okay, well, that's interesting. I didn't know that. So earlier on, you mentioned VAT. And so can you tell me a little bit about VAT as a sole prop? Who do sole props also need to register for VAT? And, what do you need to know if you are liable to register for VAT? What do you need to know in terms of being proactive so that you are prepared for VAT times?
So technically, but in this specific space, medical professionals, a lot of what you do is tax exempt, a lot of it, not all of it. Then you might find a few things here and there where it's not. But the rule of thumb is that if you make over R1 million a year in 1 year, you have to register for VAT and charge 15% on your services. What you will find with a lot of medical professionals is that if they get to a point where they've scaled so much, and this is what's happening, they will be paying a lot of VAT. Not that they're affected in any way, because they're literally just adding 15% on the normal amount. So they'll be paying a lot, but not being able to balance it out with deducting VAT allowable things, because they don't have many VAT allowable expenses. And a huge portion of that is usually human capital, locums, all of those types of things. You're not really going to pay people. They're not going to invoice you with that in most cases. So that is what tends to happen. But for the most part, you want to try not to do that for as long as possible. There are many, many ways you can also reduce your taxes, like turnover tax is a great alternative if you also don't want to go the full. You can be a sole proprietor, have turnover tax, and not have to pay so much in terms of tax as well, and not have to do financial statements. So there are a lot of ways that you can kind of deal with the tax situation. Turnover tax takes over for that. But the moment you reach the 1 million, you can't have turnover tax, and you might have to do that depending on, the specific circumstance, because, like I say, a lot of it is not vatable.
So I've heard about turnover tax before. Can you explain that to me? What is turnover tax and why is that different?
So turnover tax is there to try and ease the burden of new businesses administratively, right? So the whole case for turnover tax is that it's supposed to replace the VAT, it's supposed to replace the VAT tax type, and it's supposed to make life easier, right? Like, what they're doing is not taxing you on profit, they're taxing you on what you make, and they don't care where you spent the money, whether you decided to pay yourself a salary or not, or they don't care. They just want to know how much you made, and off the basis of that, then they're going to deal with the tax rate for that. It is helpful. It's very manual, and you can only register for it like like if you register for it, you stick with it. And if you deregister for it, you don't get to kind of go flip-flop between the years for it. You have like a 5-year period that you can't register for it again. So some people are able to do that again if they don't meet the definition of a personal service provider. If they do, that's where it becomes a little bit, you can't do it. But that's where you have to start figuring out how you cannot become a personal service provider.
So I've also read about that where there was some tax incentive, but it was for personal. Well, is it that personal service providers are excluded from that tax incentive? Can you just explain that? And would we as health professionals then be considered personal service providers because we are providing a personal service, aren't we?
Yeah, a lot of people are. They do get confused about the point or the gist of personal service providers. So personal service providers are people who would otherwise be considered employees. That's the main kind of thing. And they point out in the Act kind of examples of people who might meet that definition: lawyers, accountants, healthcare professionals. You might see that. You need to understand why they're trying to kind of highlight those industries. So personal service provider is someone who might otherwise be considered an employee, and you're trying to, it's an anti-avoidance tool, and you're trying to maybe open up a company or be a sole proprietor or register for turnover tax or small business corporation tax to take advantage of the tax incentives. But if you remove this vehicle of a company, it's like the Scooby-Doo thing, surprise, who's here? You are still would be like an employee. So it's to avoid someone from like resigning from a big corporate where they're earning $1 million bonus and saying they're a consultant rather, and then getting their R1 million deposited in, still being able to deduct the deductions, and then having a preferable rate as opposed to, 45% tax rate. You now have like a 10% or even 0% tax rate. That's where they're trying to get that avoidance. Okay. But there's actually a flow chart for this on one of SARS's interpretive notes. But if you are what they're trying to get to is, are you independent? And the biggest question is, do you earn? This is where there are a lot of, like I said, it's yes, no, do you keep going on this thing? And a lot of it is, do you make more than 80% of your income from one source? And that's the one that will trip most people up. And a lot of people do, unfortunately. And that's where you might then fall in the definition of a service provider, because it's basically like you would have been employed.
Okay, I understand now. When you said that kind of light bulbs went off, because obviously, as if I have multiple clients who are paying me, then I'm not getting 80% of my revenue from one source. Whereas if I have one client, like let's say I'm working for the employee wellness company is my client, so I have lots of clients under that, but that's my client who I get paid from. Mm-hmm. And then, a few here and there as well. But because if 80% of my retainer or whatever I get comes from that client, then I'm technically not independent. That's basically what you're saying. And I think that also why the light bulbs are going off is because, I'm very big on like health professionals needing to be more ethical in terms of the employment practices, because there's a lot of unethical stuff going on out there. And I could never understand that point when the employment ethics person spoke about the difference between an independent contractor and when you are actually employing someone. And she spoke about that. That's what she meant. If the person is actually 80% of the salary, the money they're getting is coming from you, then they're not an independent contractor because they're not independent from you. So that makes sense because it has tax implications for them as well.
So I do get into this kind of jousting over little words a lot of times because people don't understand the gist of what it is. And that's why it's important to even read interpretive notes. And anybody can read that. If the Tax Act is a little bit too, if it's a little bit too jargony, a little bit too heavy, wordy and all of that, you've got like a 5-10 page interpretive note that helps you understand what is going on. And they start to unpack specific points of contention, because sometimes the act is not that clear as much as people might think it is. It's sometimes not. So we do look at different, maybe accounting bodies and understanding how other accounting professionals are treating certain tax types in certain situations, but SARS sometimes comes out with that and answers those questions. So there is a beautiful flow chart that teaches you or shows you if you fall into that. So you might, yes, be a connected person rendering the service, meaning you are the person who owns the company or is the company and is rendering the service. You might not have 3 or more employees, right? So that's just a test. Like, are you independent? What's going on? And those employees are not connected people. Maybe you don't. You might not. So there's another thing, like, are you under the direct supervision of the people? Like, do you have to report to someone? Are you under direct supervision, or do you work most times at those premises, right? And then you're like, no, I don't. I'm kind of independent. Then you continue. If you said yes, you are a personal service provider. If you say no, you continue. And then do you derive more than 80% of your income from one source? And if you say no, then no, you're not a personal service provider. So you can say yes to all of those other things that, most people want to kind of hang on to. But if you kind of proceed through the flow chart, you'll see that sometimes people just don't. They don't fall into that.
Yeah, that makes complete sense. So I just wanted to also ask then, what happens? A lot of health professionals start their private practices initially as a side hustle until they feel confident to be able to give up their jobs. So if you are employed and they are deducting pay as you earn, and now you also start a practice on the side as a sole proprietor, how does that work in terms of tax? Do you still need to pay provisional tax for the business side of you? And then, how does that work?
Yeah. Your tax return is an interesting thing. It's like a flower that keeps unfolding depending on what you select, right? So your normal tax return is just going to be like, boom, IRP5, IT3, it'll have medical aid details. So if you got that, it will usually populate automatically. Your IRP5s are going to come from your employer and you're good to go, right? Then you have to do this thing where you run through a couple of questions and then it starts unfolding. And it says, it goes into more comprehensive income questions. Did you derive any income from overseas? So foreign income, then you have to deduct that. Did you have any non-taxable income? Did you win the lottery, right? You declare it there. And then it'll ask you questions of, did you carry out any trading activities? And then they'll ask you how many separate trading activities. Well, you would just having a private practice. But if you had a private practice and then you had a random fishery on the side, and then, you had a tuck shop or something, you'd put that all in there. And then it unfolds. And then it will say things like, it will open up the options to kind of fill in those blanks of, entertainment fees, So it depends on what you're selecting. That's why I say you don't register to be a sole proprietor. You can select it in that return. So your IRP5 will be contained in there, and it will kind of be like the ring fencing, right? So everything related to your IRP5, the deductions, the medical aids, the annuities, all of those lovely things that reduce your IRP5 will be ring fenced to that. And then all the expenses and things that reduce your sole proprietor elements of your tax return will be ring fenced to that. And then they will kind of just give you the consolidated amount.
So as a sole proprietor, now, obviously, when you're working for an employee like state or another private entity, for example, you deduct pay as you earn, they deduct UIF, then maybe they contribute to a pension fund, and those are all deducted. And so your tax that you pay is less, right? So as a sole proprietor, are there any things that normally practitioners would consider as an expense and I don't have money for this, that actually they should consider it as something that in the long term will save them tax, and then the benefit is that now they've got this cover or this investment or whatever?
If you're talking about investment products, they don't do so much for the sole proprietor side as they do for the personal side. They're not really a deductible. The reason they're not a deductible is because they're not technical. In accounting terms, it's not an expense. So it becomes an asset. And those assets don't necessarily depreciate. They will attract capital gains once you decide to cash them out. But they don't qualify as a deduction. Things that would qualify as deductions would be things like your insurance. You've got your liability insurance. You've got security costs for the property or wherever you are. Your Zoom subscription, your practice management subscription, And even if you buy like a laptop or a car, or you buy, that's what you can deduct. So even things like a car, right? That's a big deductible. Many other things that you can do that can deduct it. But in the way that we're going is more of an asset type of thing. But what is happening is the state isn't trying to incentivize citizens to be more proactive with their finances. So they incentivize you to, do things like investing in venture capital firms as a form of an investment for yourself and as a way to help stimulate the economy, because venture capitals really target kind of startup companies and try and boost these micro economies. So that's the rationale behind it. Your pension, there's now going to be a 2-3 part system of your pension where you can only access some of it and you can't access another part of it once you are retired. So those are the types of legislative changes in a personal capacity where they're just trying to get citizens to have a lot more cash on hand or save a lot more cash.
And then products that are not investment, but they do cover you, that's not insurance. So like critical illness cover or insurance to cover the expenses of your business, that kind of thing. Would that be considered an expense?
Yes, that would.
Okay. And then the last question I wanted to know is, so you mentioned that tax season has just ended for personal tax. So we now, so what do people need to know about right now? I mean, obviously this video is evergreen. But right now we are sitting in November. So what are there specific dates that sole proprietors specifically need to just have big and bold on their calendars that they can prepare for that, so that it doesn't, spring up on them? Because most sole props aren't consulting with an accountant even, they're trying to do their own books and things like that. So how do they kind of prepare themselves if they do insist they want to DIY? Like, what do they need to know about? And then what steps do they need to take to, not have to, like, on the last minute, have to scramble together like some kind of a tax return?
Yeah. The biggest thing, the dates are always 28th of February and 31st of August. Those are the times you need to submit. Feb is always 2 returns. August is always 1. The other thing that the person needs to consider is how comfortable they are with using SARS and how comfortable they are if they get something wrong. Because a lot of the audits, and I think this is probably why people are afraid of audits, a lot of audits arise out of incorrect returns that are submitted. So it's very important to know how to use SARS e-filing and then how to actually submit the bookkeeping that has been done onto a portal that has tax laws, because people think it's just the SARS portal, but it's actually a codified version of the laws. So you need to be able to know, what am I selecting and what does that mean and what does that translate to legislatively? And then how do I kind of put what I've done on paper into the return? What they do need to know is that SARS is getting a lot stricter. They've done like 403 detainees. They've done a lot of seizures. They've seized about 200 million in assets, just like from Feb to September. So they're really looking to delve into those returns and kind of figure out what's going on and what, especially if there's a mismatch from your personal side and they're also looking a lot at your bank. So if you're not able to account correctly for everything that's coming into your account, they're like, that's a bit of a mismatch. We need to understand why. I can see into your bank and you're not telling me, just tell me, and then you're not doing that. So it's very important to know how well you can deal with the problem if it arises and how to not create a problem. And then to know the dates, which is in Feb and in August. So actually sole proprietors season is fast approaching.
Thank you so much for that information. This was very informative. I definitely learned a lot, and there's lots more questions, but I think we'll save that for another time. And of course, today we spoke mainly about sole proprietors. I'd love to have you again at some point in the future to talk about companies. Obviously, as health professionals, we can only register as incorporated companies, but there is the loophole of registering a utility company as a PTY. So there's a whole other mess there, that what if you have a PTY and an Inc. or a PTY and a sole prop, and how does all of that fit together in terms of tax? So that's a whole conversation for another day. But thank you so much for your time and for sharing all the information. I'm sure people find it really valuable. So if anybody feels like, oh my word, there's so much that I don't know, I need to like have a consultation with this woman?
Yeah.
What do they do? Tell me about the services that you provide and how can people get hold of you?
Okay, so we always start off with a consultation. It's a paid for consultation. We have different rates for different times that we spend with a person. And what people do is they just head over to the website, www.lordebusiness.solutions, and it's really, really simple. You go in, you book a time slot, you pay online, and then you get a link. And prior to that, we send out kind of a guide to help you maximize on the time. So it doesn't just feel like, we're talking. And out of that session will arise a strategy on how to actually approach the taxes for that individual. So that's how we start. And that should put a lot at ease. If people want to expand on that and they want to have like a written down plan with calculations and all of that, then we sit down and we actually do the calculations based off of projections and other information. And that's a tax plan. And then we also do the admin part of it. So these financial statements that we're talking about, all of these registrations, your turnover tax registrations, your company registrations, trusts, all of those types of things. We also then look into that, and then the monthly bookkeeping, should that be a need. So that's what we do. And that can be either on my social media or on my website. Tax with Tash is the social media. And then the website is that lordebusiness.solutions. And then we're available.
And I'll definitely put all of those links and information in the description box below the video. But definitely I want to recommend, even if people don't want to necessarily have a consultation, to go to Tax with Tash on Instagram. It's really, really very informative. Like, I think I've binge watched everything on your channel.
I love it.
But what's nice is that it's really short. It's not like, obviously YouTube is not content, so you take the time to like listen through everything. But it's nice if you just want to go through and like get short, and you've got all the titles on, so people can pick and choose what the information is relevant to them, which is really great. So I'll definitely link to that as well, to the social media below. Thank you so much, and have a great day.
Thank you, Tasneem. Thank you for having me.